and a very warm welcome to everyone who's been able to join today's session. This is the fifth in the Oxford Tax Law and Policy Discussion Group's series of events this year. Welcome to everybody. Please could colleagues joining the call in the chat room just identify themselves and their institutions. So for example, Professor Mason, who we'll introduce in a second, can see where people are from and potentially follow up or what have you, and anything specific. So if you could just identify yourself in the chat room together with your institution, that would be extremely welcome. Delighted to welcome today Professor Ruth Mason, Edward Cohen Distinguished Professor of Law at the University of Virginia. Professor Mason's held a number of other senior academic posts, including visiting professorships at University of Yale and Paris Sorbonne, as well as being the visiting professor in residence for the IBFD in 2018. Professor Mason is known to a number of us because, of course, she has represented the University of Virginia in the Oxford Virginia Dialogues that have started recently. So we're immensely grateful to Professor Mason for agreeing to speak to us today. Her subject is identifying illegal subsidies. And the heart of this is the question of what should be the frame of reference, the benchmark by which any subsidy might be evaluated. And Professor Mason's article that she's going to talk to compares and contrasts the approach in the EU with her recommended approach in the US Supreme Court, which is the internal consistency test. And so with that brief introduction, I'd now like to hand over to Professor Mason to give us her presentation on identifying illegal subsidies. Thank you.
Great, so thanks very much, Paul, and thanks so much to Oxford for the invitation today. I'm really happy to be here. Today's presentation is going to be about hard cases, hard state aid cases. What makes them hard, okay? And is there any help available to us in resolving these hard cases? So before we talk, about the paper, I want to tell you where you can find it. You can find it on SSRN. I have a bunch of other papers on SSRN. They're both, both papers targeted to a practice audience, but also papers targeted to academics like this one. Okay, so starting at the beginning, we can see Europe as valuing two types of competition. So we have private competition between private enterprises, and then we have regulatory competition among the states. And the European Union really prizes both of these types of competition, and the prohibition of state aid limits states' ability to interfere with private competition. It's my contention that state aid does not interfere with, to a very significant degree, with regulatory competition, that is, states' ability to compete with each other. Okay, so going along with the competitive values of the EU, what are some other EU values? What are the goals of the common market? And the reason why I'm starting here is because in order to understand what state aid is for, we need to understand, or what state aid does, we need to understand what it's for. Right? And to understand what it's for, we need to know its purpose, and that's part of, should be aligned with the overall purposes of the EU. Okay, so the goals of the EU generally: reduce internal barriers to assembling capital, labor, and resources on a larger and more efficient scale, facilitate efficient geographic allocation of productive factors, facilitate efficient production, regulatory competition, facilitate that, raise the standard of living for Europeans, and serve as a counterweight to the United States. Now, what are state aid's values? Well, this is harder to pin down. At a minimum, the prohibition of state aid aims to level competition between private enterprises of different states. Relatedly, to prevent states from picking particular enterprises and subsidizing those, like national champions. But there are lots of other possibilities for what state aid is either meant to do or could be used to do. It could be used to try and effectuate locational neutrality, to curb tax competition or other cross-border externalities, to ensure full taxation. Sometimes you hear public officials in the commission talking as if the state aid ensures full taxation or single taxation. It could be used to impose fiscal discipline on the states, right? Overcome state level interest group politics that end up subsidizing national champions. The commission staff has even said in a draft paper that state aid should be used to enforce a particular distribution of the tax burden between capital and labor. Like, that is a radical view of what state aid should be doing, and pretty far afield from preventing states from interfering with private competition. Okay, so we have my assumption in this paper about what the state aid goal is that it is at least in part about competition among private parties, okay, preventing member states from interfering with private competition. It is about this is not meant to be a controversial assumption, okay, but I want to make it clear. If this assumption is wrong, or if EU law evolves, for example, to encompass more goals, then the idea that I set forth in this paper would only be relevant, possibly only be relevant to just the private competition part of this. Okay, so what that means, right, is that in my view, state aid is not primarily about curbing regulatory or tax competition among the states. The most important consequence of that assumption is that mismatches are okay. Okay, so mismatches in rates, in base, in definitions of residence are okay. So to my mind, the prohibition of state aid is not about locational neutrality. State aid control may reduce regulatory competition, and it may advance locational neutrality, but it only does so as an instrument. You know, that's not the primary goal. It may do so as a complement to its main goal, which is to promote private competition. Okay, so unlike the claim that state aid is about private competition, this claim is more controversial. Okay, so for example, the case Gibraltar can't be explained by a private competition model of state aid. That means, you know, in my view, either Gibraltar is wrong, or, you know, the commission needs some kind of other instrument to get at Gibraltar. We'll come to that. Okay, so, you know, what are we talking about here? What's the treaty language? You all know it, but let me just read it here. So Article 107 of the Treaty of the Functioning of the European Union, save as otherwise provided in the treaties, any aid granted by a member state or through state resources in any form whatsoever which distorts or threatens to distort competition by favoring certain undertakings or the production of certain goods shall, insofar as it affects trade between member states, be incompatible with the internal market. Like, so I've just now described all the taxes. Every tax meets this description, right? But they're not all state aid. So which ones are state aid of those that fit that description? Okay, so here we come to the elements of state aid. You know, state aid has to be, you know, for something to be state aid, it has to be selective, granted by a member state to a member state, to an undertaking, and distort trade. Okay, the only of these elements that's actually really important in a tax case is selectivity. Okay, so of course, tax aid is always granted by a member state. Undertaking, well, that's just a trivial element. Distortion of trade could be an important element, but it hasn't been. So the commission assumes that if there's a selective advantage, that it distorts trade, and the Court of Justice is okay with that. So really everything turns on selectivity. So what's selectivity? When is a tax advantage selective? Any tax advantage that doesn't apply without distinction to all firms and to the production of all goods. That was how it was stated in the 1998 notice, now withdrawn. Whether it's, you know, something can be selective de jure or de facto. If it's selective, then it has to be justified by the general or nature or general scheme of the system. Otherwise, it's prohibited. Okay, so we can talk about what some justifications are. I don't really think it's that clear on the law so far what a justification in the nature or general scheme of the system is, but progressivity is an example. Okay, so progressivity is selective, but it's not state aid. Okay, so, you know, up until the last few years, the way state aid has been discovered is through what I call a tax expenditure approach. That is, the commission uses a reference law benchmark to determine whether there's been a selective advantage. So the commission compares the state's tax treatment of the putatively favored undertaking, right, the selected group, with the same state's treatment of similarly situated taxpayers under generally applicable domestic law. That's, you know, as tax people, we recognize that as a tax expenditure approach, okay? The emphasis is on favoritism to what I call suspect classes. That's what we call it in US law, right? But selective classes. Okay, so then what's a selective class? What kind of classifications do we care about? Sector, region, nationality, maybe also including size. More and more it's looking like not size. Engagement in cross-border activity, is it, you know, does it something that affects imports, exports? And then individual aid, the most selective form of aid, that's when a country subsidizes a particular company. So those are the selective classes. These classes make sense as the selective classes if the goal is to promote competitive neutrality across businesses of different states. Okay, if you're interested in like how I devised this set of suspect classes, I have a paper on that in tax notes. It's called An American View of State Aid. So if you're interested in that, you can check that out. Okay, so under the tax expenditure approach, you find your selective class, you see whether they're granted an advantage, you see if it's justified. If not, then there's prohibited aid. So just as a, for instance, what kinds of cases have arisen under this reference benchmarking approach? There's a bunch of cases where the Court of Justice said there's no aid here, okay? And the reason why there was no aid is because the classification used was not selective. The preference wasn't given to the wrong class of taxpayers. So for instance, a payroll and property tax limited to 15% of the taxpayer's profits. Well, there's a selection there. You know, so companies that have more than 15% profits or that have more income are treated better than those who have less. No problem, not a selective class. Exemption for pass-through companies that was denied to corporations. Well, there's a selection there too. Pass-throughs get treated more favorably, but they're not a selective class. That's okay. A procedural rule allowing companies with disparities that are over 10 years old to settle a dispute by paying 5% of a deficiency. There's a classification there, 9-year-old disputes versus 10-year-old disputes, but it's not selective, so no problem. Accelerated depreciation rule limited to certain tangible assets custom built for leasing, but not other kinds of assets. Again, no selective class, no suspect class, not state aid. Okay, but in contrast, what has been held to be illegal aid? Social security tax exemption available to the textile industry, but not other industries. Right there, you have a selective class, sector, textile industry. Tax incentives available for investment in former East Germany, but not other parts of Germany. Again, a selective class. The selection there is region. Exemption on exemption from tax on stopovers available to local, but not foreign vessel owners. Right here, the selection is nationality of the owner of the vessel, a suspect class. Faster recovery for foreign stock than domestic stock. Again, you know, treating a foreign investment better than a domestic investment implicates a suspect class. Okay. In each of these cases, the commission uses the challenged state's own law as the reference base, right? They're deviating in order to give the selective class a special benefit. And that deviation is clear on the law. It's written into the statute. Okay, so this tax expenditure approach was great for a while. I mean, and it's great in lots of cases. If you have an overt tax benefit that's going to a selective class, The tax expenditure approach works great. And it avoids entangling the commission into political questions. So the commission doesn't have to say what the tax base ought to look like. It just says that whatever the tax base is, it has to apply the same to suspect and non-suspect classes. At the same time, the tax expenditure standard was not toothless, right? It found illegal subsidies. Okay, so that works well most of the time, but in the recent cases, there was a problem. So there are two kinds of what I call hard cases. These are the cases that the tax expenditure approach doesn't work for, okay? And that is facially neutral rules that have disparate impacts. So they don't read as tax expenditures on their face, but they deliver benefits to a suspect class. Facially neutral rules, disproportionate impact. And then the second one is facially selective rules that don't inhibit free trade. They don't upset private competition, okay? These two kinds of rules, this tax expenditure approach is no good for. In the first instance of facially neutral rules, the tax expenditure finds no aid. In the second case, a facially selective rule that doesn't have the relevant kind of impact, well, here the tax expenditure approach finds aid, okay? Okay, so let's start first with the facially neutral rules with a disparate impact. If the rule does not overtly discriminate against the suspect class, then the tax expenditure approach will not identify it as conferring aid, okay? So think of structural rules, tax rates, tax mix, tax unit, and important for us, allocation rules. These, you know, we have a question about these. Are they always part of the reference law so long as they're not overtly selective? Does the reference base incorporate them automatically? If so, then that's potentially a problem, because everyone knows that structural rules can convey tax benefits, can convey subsidies. So if your income allocation rule, for instance, systematically allocates too little income to your jurisdiction, that's something that state aid should worry about if state aid is worried about competition between private enterprises. But a tax expenditure approach will not get at that rule if it doesn't describe a suspect class. Okay, this was the Gibraltar problem. Okay, so the main problem in analyzing Gibraltar under a reference-based approach was that the regime was facially neutral. You can't find the tax expenditure. So we're going to come to Gibraltar. Okay, so what might you do with the facially neutral rules with disparate impacts? Okay, so one is you might just ignore them, right? This is the default approach of tax expenditure analysis. The government would just incorporate all the structural provisions into the reference base. You know, the commission would, and you know, and this is often what happens in tax expenditure analysis, right? The structural rules are considered to be part of the base. They don't score as tax expenditures. Marginal rates, filing statuses, income allocation rules. Okay, so that is sometimes what the commission does. It ignores them. So here are some examples. McDonald's. Here the commission effectively incorporates Luxembourg's tax treaty interpretation as part of the reference base. So Luxembourg had 25 rulings, just like the one that it gave to McDonald's, right? Saying that, you know, the branch would have, under Luxembourg law, the branch in the United States would have been regarded as a PE, therefore the US should have been able to tax it as the US should have been able to tax it. Luxembourg feels itself obliged to exempt. You know, that was Luxembourg's interpretation. That doesn't have to be the interpretation of that provision, right? Fadi Shaheen wrote a whole article about how that was the wrong interpretation of the treaty, and Luxembourg should have said that since the US doesn't in fact see a PE under its law and didn't in fact tax, Luxembourg is not obliged to exempt. And that would have been, you know, their bench, it's not just Fadi saying that, right? The OECD gives that as a recommended approach, so that there were external sources the commission could have relied on to require Luxembourg to interpret the treaty consistently with a single tax result, but it didn't, right? The commission instead essentially treated Luxembourg's tax interpretation rule as part of the background structure. The Apple tax residence mismatch, right? So the European Commission never challenged this. I mean, we don't know exactly why, but we can read it and say, you know, maybe the Commission regarded the tax residence rule as a structural rule, part of the reference base. But notice, right, this tax residence rule confers an enormous benefit on Apple. Okay, so, you know, here the Commission, if it had wanted to, could have used an external base. It could have said the point of Irish tax, Irish corporate tax law is to tax all the companies. It did this in other cases, right? And not to leave untaxed income. And as a result, right, the Commission could have said under an external reference base that this residence rule was not okay. Vodafone and Tesco Global, here, the General Court of the EU, well, now that affirmed by the Court of Justice, says that the graduated rates are part of the reference base, okay? But it easily could have seen the lower rates as a deviation from the higher rates, right? Or, you know, vice versa. So the indeterminate nature of this inquiry, right, is high a deviation from low, is low a deviation from high. This is the nature of the problem, right? We don't know what the baseline should be. The problem with ignoring structural provisions by incorporating them into the reference base is that sometimes structural rules discriminate, right? And I think Tesco and Vodafone are a great example of that, right? So, you know, Hungary uses a neutral classification turnover size, but it does so with the intention and effect of discriminating against non-resident companies, foreign companies. Gibraltar uses a facially neutral regime, right, to discriminate in favor of foreign companies. So not all cases of facial neutrality are cases of innocent mismatches, disparities, differences across different rules of different states that are properly ignored. Okay, so what's our second option for dealing with neutral rules with disparate impacts? The second option is find them to be state aid by some other method. You can't use the traditional reference-based approach for this, so you got to make something else. You got to reach for some other tool. Okay, and so here I think there are two sub options. Sub option A is find the advantage by reference to an external reference base, and the external reference base can be something that the Commission invents, a dominant state practice, or an international consensus rule like arm's length standard. Or option B, find the selective advantage by looking at the impact. Okay, and the Commission has taken both of these approaches. It took both approaches in Gibraltar, and the Court of Justice approved, although it later limited the precedential effect of Gibraltar. So in Gibraltar, we have an entire corporate tax regime invalidated as state aid. The regime was a payroll and property tax capped at an overall percentage of the taxpayer's profits. It applied uniformly to all companies, so no overt selectivity, no tax expenditure. As applied, however, it would have favored offshore companies that just because as a factual matter, they would lack property and payroll in Gibraltar. And like this effect was on purpose. Let's not kid ourselves. This is what Gibraltar was trying to do. Okay, so what did the Court of Justice do, or the Commission do in this case? It took an external reference-based approach. Interestingly, the Court of Justice claimed that the Commission did use reference-based in Gibraltar, but instead of a reference-based composed of actual Gibraltar law, it was composed of the object and purpose of Gibraltar law, which the Commission and the Court of Justice asserted was to tax all companies. Okay, so it's unclear what this tax base looks like and how you would ever measure recovery from it. But the Commission and the Court of Justice probably had in mind something like a comprehensive corporate income tax base. I mean, let's just, as a side note here, a universal comprehensive corporate income tax base cannot be found in the TFEU. you know, a comprehensive corporate income tax quite obviously was not the actual object and purpose of the Gibraltar tax regime, which was instead to create more like something, you know, to create a ring-fenced preferential tax regime. Okay, so you know, one option is, you know, make up a reference base and measure the deviation by reference to that. The other option is the disproportionate impact approach, also used in Gibraltar, right? The commission would just dispense with the reference base and just say, hey, look, the wrong kinds of people benefit, the wrong kinds of taxpayers benefit. This is a problem from the state aid perspective. So you see this in Gibraltar, right? The regime as applied would favor offshore companies. So notwithstanding that it was facially neutral, it was state aid by impact. Okay, so far we said that the reference-based approach works well in cases of facial selectivity, what I like to call the easy cases, but there are two kinds of hard cases. One is Gibraltar, right? Facially neutral, but selective impact. For those, you either ignore it and you ignore the reference-based approach and you use an external reference base, or you take an impact approach. The second kind of hard case is a facially discriminatory rule that does not distort private competition, okay? So some rules, including most income allocation rules, are necessarily selective on their face, okay? So different rules apply to residents and non-residents. This just reflects differences in the state's jurisdiction over each group. Does this mean that all such rules are state aid if they confer benefits? In many cases, the state's jurisdiction over the non-resident will be more limited than their jurisdiction over residents. So the non-resident will experience less tax by that state, but that doesn't mean that that non-resident gets a relevant kind of advantage, that there's a distortion between amongst private enterprises. Okay, so just some examples, are all favorable tax treaty interpretations state aid because double tax treaties only apply to cross-border situations. So McDonald's then is wrongly decided. Or are all advantageous mismatches state aid because they only arise in cross-border situations by definition. Okay, does it matter if, like Ireland, they tried to create the mismatch as in the residence rule? Okay, so Apple as an example. So how do you know if Ireland's branch allocation rule confers illegal state aid? Ireland's branch allocation rules are facially selective. They only apply to branches. They only apply in cross-border situations. It's not the same rule for the foreigner as the domestic person. But they have to, right? They inherently only apply to cross-border situations. So now we need to know whether, so they're selective on the face, but you know, do they confer advantages, relevant advantages on the selective group? You know, and how do we determine that? Here we find another baseline problem. These baseline problems really stymie tax expenditure analysis. So to the extent that the state aid rules depend on tax expenditure analysis, that they depend on a reference base, you know, the problems are inevitable. What's more, they have no satisfactory answers. What is the proper reference base to determine whether Ireland's branch allocation rule conveys selective advantages? Is the reference base the treatment of domestic companies? But it's not a domestic company, and Ireland doesn't have unlimited jurisdiction over it. It's a branch, and Ireland only has limited jurisdiction over it. That matters, but how does it matter? You can't just say that a residence non-residence difference justifies any kind of difference in treatment, okay? But you also can't say that residents and non-residents have to be treated the same in the way that the commission has been lately, because that's nonsensical. So where do we find a path between these two impossible points such that we can actually further the goals of state aid? Okay, so we're in a quandary, right? Now, in this quandary, the commission itself gets creative. This brings us to Apple. Remember, Apple is a US resident company. It's got these non-resident or nowhere resident subsidiaries incorporated in Ireland, managed and controlled in the United States. And then it has, they have branches in Ireland. And the question is, how much income has to be allocated to the Irish branches? Ireland claims that although it doesn't use the arm's length standard to allocate income to the Irish branches, it uses a consistent, apparently one-sided, method that looks to the activities in Ireland. According to Ireland, it follows its own domestic law when approving the ruling, and that these rulings said that Apple would declare income consistently with an appropriate return on its Irish-only activities. But there was an obvious, uncomfortable, and ultimately unacceptable fact, right? Apple had loads and loads of untaxed stateless income. But by Ireland's account, it did its duty under Irish law. It taxed the part owing to Ireland. And if the United States or other EU countries didn't tax the rest, well, that wasn't Ireland's fault, okay? So as in Gibraltar, the commission in Apple reaches for an external reference base. It's important to understand why, though, right? Why is this a hard case? Why does it drive the commission to reach for an external reference base? This is not just a power grab the way it's been described on the part of the commission. There is a reason why the commission is looking for the external reference base, because tax expenditure analysis just doesn't work in a case like Apple. And so the commission takes as its reference base, right? This is an example of a facially discriminatory rule, right? But one where there has to be a difference between resident and non-resident. And do you have a relevant kind of advantage or not? And so the commission measures this by the external reference base. It advances this idea of an EU arm's length standard. And this EU arm's length standard is close to, but not identical to, the OECD arm's length standard, and says the commission, and this part's important, it doesn't matter what Irish law said, okay? This external reference base applies as a matter of EU law, anything in Irish law to the contrary notwithstanding. And you get similar statements in the other income allocation cases, the other transfer pricing cases. All right, we just had a decision in this case by the lower court of the EU, which said that the commission can't just make up the reference base, okay? It vacated the commission's decision in Apple. That decision has been appealed. We can talk about the specifics of that in the Q&A, but that's the idea. Now we see why the commission is driven to this external reference base. It's because its domestic law reference base doesn't work in that case. Okay, so problems with the commission's responses to this failure of the tax expenditure approach. It's unpredictable, okay? When is the commission going to ignore disparate impact, as in McDonald's? When will it supply an external reference base to eliminate it, okay? It's illegitimate, right? How does the commission get the authority to make up its own arm's length standard? So the commission, seems like it deserves its reputation for ad hoc decision making, but how to handle disparate impacts is a genuinely hard question that implicates EU fiscal federalism, the relevant competence of the member states, and the commission. Okay. The other problem with this external reference-based approach is that it leads to poorly reasoned decisions, right? So did Ireland confer state aid because its allocation rule treated multinationals better than domestic companies, because it treated Apple better than multinationals, or some other reason? It also invades the member state tax powers. So the commission knows that Ireland can't use precisely the same allocation rules for resident and non-resident companies, but it also knows that Ireland can't favor one set of those companies over the other. But it doesn't specify how they can be treated differently. The commission tries to smooth over this problem by saying that the arm's length standard likens the treatment of multinationals to that of standalone companies, but the assertion is unsupported, and in my view, unsupportable under current law. So when the European Commission uses external reference bases, it exceeds its institutional competence it pursues tax harmonization or single tax in some cases. But again, this is a hard problem, right? The way to analyze rules that are necessarily selective, that have to distinguish between residents and non-residents, it's not obvious. The commission shouldn't just say that all income allocation choices are up to the state and unreviewable as state aid, but it seems equally inappropriate to say that every selective law is putative state aid that has to be justified. Okay, so this brings us to the solution. Luckily, the solution's short, okay? And this is in the US Supreme Court. Okay, so the US Supreme Court faces exactly the same problem, but in reverse. So the US law doesn't forbid subsidies, discriminatory subsidies, but forbids discriminatory taxes. Okay, so this is the dormant commerce clause issue. You can think of it as being a functional equivalent of the fundamental freedoms. Okay, but there's a technique that the Supreme Court has developed to root out, to identify discrimination that works equally well in state aid cases, and that's the internal consistency test. So the internal consistency test comes out of an income allocation case, and it would, right? Because that's where those are the hard cases. So in this case, Mormon, Illinois had a single factor sales rule at the same time that all the other states had a 3-factor sales apportionment formula. Okay, so Illinois had this outlying formula. Taxpayers sued, saying that on account of the differences in the formulas, it suffered double tax. But the Supreme Court said that the Constitution doesn't indicate what the apportionment formula should be. Sound familiar? Okay, so it only forbids discrimination against cross-border commerce. So how can the Supreme Court analyze this facially neutral allocation rule? Right, the court could have said 3-factor, that's the standard, or it could have said, arm's length, that's the standard. I could have provided and supplied an external reference base, but it didn't. Instead, it reached for this internal consistency test. It said, imagine all 50 states adopted the challenged states rule. Would cross-border commerce face more tax than purely domestic commerce? If the answer is yes, the state law is illegal unless justified. If no, it's generally permitted. You would just alter this for state aid and instead ask if all the member states had the rule, would cross-border commerce suffer less tax, right, than domestic commerce? If yes, then it would have to be justified, right? Okay, and if no, permitted. Okay, so why does it work? It identifies what economists call capital ownership neutrality or competitive neutrality. It identifies when the state all by itself has created an advantage or a disadvantage for one set of private enterprises over another. Okay, so going back to the cases we discussed, how would they be decided under an internal consistency approach? Well, McDonald's, if everybody uses Luxembourg's conception of a PE and business profits, then that branch in the United States would have been a PE and the US would have taxed it, and there would have been no double non-tax result. You would have gotten full tax. So this, under the internal consistency test, would pass muster, okay? The Apple tax residence mismatch. Well, if everybody had Ireland's residence rules, there'd be no stateless companies, okay? If everyone had Ireland's rules, those stateless Irish subs would have been taxable in the United States. No income would fall through the cracks. Gibraltar, if everyone had Gibraltar's rules, then all income would be taxed. And in fact, it would be taxed in the places where, the real substance was. Okay, so in practice, the internal consistency test does not mandate single tax because different countries can have different regimes so long as each of those regimes looked at individually is internally consistent. So in the real world, you can get double tax in the same way that the result of that Mormon case was that Illinois got to keep its rule even though the other states had a different rule, and in real life, there was double tax, right? The point is that each state is held individually to a non-discrimination rule. It cannot put into place a system that is internally inconsistent analyzed alone. Okay, so what fails internal consistency? The Italian textile case. If every state has a rule that says that textile workers don't pay Social Security tax, well, that fails. That's a sectoral discrimination. It doesn't disappear under internal consistency. It's not due to a mismatch. It's due to the Italian rule. World duty free, right, where you get faster recovery of foreign investments than domestic investments, that kind of difference does not go away under internal consistency. Audrey Aveen, and so on. All the old cases fail internal consistency, except Gibraltar, which passes, okay? Vodafone and Tesco fail internal consistency. The disadvantage for foreign companies does not disappear if everyone has that graduated tax. Individual aid can't even be hypothetically universalized. It fails automatically, okay? All right, so, and then allocation rules just have to be internally consistent. They need not ensure single tax. No gaps, no overlaps when applied by all the states. That's what's required to meet internal consistency for an allocation rule. You don't have to know, you don't have to say, this is the ideal allocation rule, this is the EU allocation rule. No, you just take the state's own allocation rule and you suppose all the other states had it, and would that pass muster under the internal consistency test. One-sided transfer pricing methods fail the internal consistency test. So Ireland still has to worry that it loses Apple, but now it loses Apple for a good reason, not one that the Commission made up yesterday, not because it didn't adhere to a standard that wasn't in its domestic law, right? So now the Commission can say, well, Ireland, you have a one-sided transfer pricing method. When universalized, it doesn't pick up all the income. That means that cross-border companies are treated better than domestic companies. And now you've conferred state aid. Not only have you conferred state aid, but we can measure the amount of state aid you conferred by reference to your own law, Irish law. So this doesn't have the illegitimacy problem of the external reference base. Okay, so then I just want to show you sort of the decision tree. Let's see if I can share my screen. And I'll just leave this up. You know, this is how I posted this yesterday for those of you who are on Twitter, but you know, this is sort of how the Commission would approach a case, right? So it would start here. Is the tax rule facially selective? If yes, then that's easy. Now we're in the easy cases, right? You know, apply the three-part test. Identify the rule. Identify the derogation. Is the derogation selective? No, not state aid. But if yes, was the state's use of the selective classification putatively justified? Is it an allocation rule that distinguishes foreign and domestic residents and non-residents? If no justification, that it's state aid. If yes, then you would go to internal consistency, because you might be in the situation where Ireland has to distinguish between the branch and the resident company, because it doesn't have as much jurisdiction over the branch as it has over the resident company, and you have to be able to distinguish that case. So now you come to internal consistency. You say, do all the states, assume all the states have the same rule? Are we going to lose income? Income is defined by the tested state's rules for domestic companies, right? If yes, then we have a state aid problem, okay? But if no, right, then that means there's a cross-border difference. That means Ireland defines, you know, a resident differently than does, you know, let's say France, okay? Let's say it's not the United States, it's another EU member state. In a case, but mismatches are okay as long as they're not discriminatory. So, you know, we could have, or here's the McDonald's is the example I give here, McDonald's mismatch. Now, you know, the problem with Gibraltar, so I would say Gibraltar is fine under a state aid approach, but a lot of people would be uncomfortable with that, right? So this idea that Gibraltar could on purpose create this regime that confers a tax benefit to offshore companies, right? It's poaching. Can you get at that with an internal consistency approach? No. Should you get at it with any kind of state aid approach? In my view, no. But if the Commission wants to supercharge the state aid rule, which is generally about maintaining level competition among private enterprises, and wants to add an element of no tax competition, which would not be my choice, right? Then it needs a different doctrine to get at Gibraltar. Okay, it needs to recognize that it's not about maintaining level private competition. Instead, it is about competition among the states, right, through their tax systems. And then you'd need something like there's an undue benefit. You can't benefit companies too much, even if you do it in a fashion that is non-discriminatory. You can't. Okay, and that would be the way to get at Gibraltar. But it would be extremely helpful, in my view, if the Commission could be clear about the reasons why it's deciding the cases. Like, are they about private competition the way state aid is in other areas? Or is it about tax competition, and when? Which kinds of tax competition? Because we know certain kinds of tax competition are permitted under the TFEU. And indeed, that's part of the point of the European Union in general is regulatory competition. So how far can competition go in Europe? Okay, so that's all I have. Happy to take your questions.
Thank you so much for such a broadly encompassing presentation.
It's a lot.
For those of us who, for this area is not our area of expertise, firstly, we've learned a load, but we've also, I imagine, realised how extremely complex this is. And thank you very, very much indeed for your presentation. As Professor Mason says, now open to questions for her. I think the best way of doing this would be, if a colleague wishes to ask a question, maybe just simply to raise their hand on the facility, or alternatively just to put something through the chat room. I think you can raise your hand, if I recall correctly, using the reactions button, or alternatively, in the chat phrase. So chat box. So do please raise any questions you might have through the chat box now. And by the way, for those colleagues who haven't had a chance to put their name and institution in, if you could possibly also put that in the chat box, that would be much appreciated. Wow.
Okay. See, this is the problem with this paper.
I actually have a question, but I don't have a raise hand tool. So if, so I guess because I'm a co-host or something, I didn't have that option. So just to get it started. So great. I love this paper, Ruth, as I told you, and I think it really puts the issues of state aid into such a logical and sensible way of presentation that it actually, for me, it made a lot of sense. What I wanted to ask you, and you touched a little bit about that in your very final points, was about the dynamic effect of your internal consistency test, because you could ask, and maybe this has to maybe the answer is what you said about Gibraltar and the different tool, but you could ask what kind of incentive does the internal consistency test provide for states that are interested in designing their most competitive regime in terms of tax competition amongst the states, right? So you would say, hey, look at Gibraltar, right? They had it right. Everybody else had it, so-so, right? So that's one thing. And the other one is there really, the other point is there really a complete resemblance between the Commerce Clause and the issue of state aid, in the sense that the Commerce Clause, as you said, seems to envision a race to the top in a way, right? So states are states seem as if they want to collect higher taxes from foreigners rather than lower taxes in order to attract them. At least that's what I got from you, and correct me if I'm wrong there. But if this is the case, then maybe that's an inherent difference between the US and the EU and the tax competition regime and the subsidies regime that we need to take into consideration. I see there are other hands, so I'll stop you.
Okay, good. So both of those are really good questions. So, the dynamism. What incentives would this approach provide to EU member states? And I think you can't on this internal consistency test is not an anti-tax competition tool, right? It's just about maintaining a level playing field. But it does, in fact, it can, in fact, reduce tax competition to a certain extent. Okay, so what internal consistency requires is that you treat everyone the same, right? So if you're Ireland, you would like to tax, subsidiaries and branches of US companies at 5% and Irish companies at 30%, right? This is what you actually want, is you want a true ring-fenced regime, a split-level tax system. But state aid does not permit that, okay? So you can be attractive. You can be Gibraltar and you can say, we're only gonna tax payroll and property, but the cost for that, the charge that state aid imposes on that policy is you have to have that regime for domestic companies as well. So the country has to be willing to apply whatever its beneficial system is, the system that it intends for outsiders. It has to be willing and has to, in fact, apply the same rules for the insiders. So that's the way in which state aid limits tax competition, but in my view, no further. Right? You can't tell Gibraltar, well, you just can't have a formulary. You can't have a formulary system unless you put into the formula the things I tell you to put in. No, the rule should be you can have a formula and you can put in what you want, but you've got to use it for domestic as well as foreign. Okay, so now your other question, resemblance to the US. So first, it's interesting because state aid is not just about subsidies, right? It's also about discriminatory taxes, because the flip side of every subsidy is a discriminatory tax for the disfavored group, right? So when you favor Apple, right, one way to look at it is you're subsidizing Apple, but another way to look at it is that you're assessing a discriminatory tax on everyone who's not Apple, right? So these really concepts are inverses. And, it's just strange that the US doesn't have an anti-subsidy rule. But if it did, right, I have no doubt that it would use the internal consistency test to get at it. And so, the reason why internal consistency works both for subsidies and for taxes is because what it identifies is discrimination. It aims to identify differences in treatment between cross-border and domestic commerce. And it can identify whether they're high or low, right? It just identifies a difference. And then you label it high or low. You figure out whether you're interested in the downward deviation or the upward deviation. It just identifies the difference. So that's why I think it works in both places, right? And this is provided that really what's sought after is distortions in competition across borders.
Thank you, Paul. Hi, Ruth. Good to see you. Twice in a week in the UK.
That's right.
Virtually, at least.
Yeah.
Okay, so I guess I have to say that the first time I read your paper was quite a long time ago. I got very motivated precisely when we were dealing together with some issues with Vodafone and Tesco Global. But now I was thinking about the Apple case that you were referring to, because the Apple case, and as well as the majority of the, let's say, the state aid investigations involving tax ruling in the last years, for me at least, they appear to be motivated exclusively by this frustration of tackling what seems to be flagrant cases of tax avoidance, mostly, let's say, derived by under-taxation or non-taxation connected with disparities among countries. But as you well said, state aid rules were not designed for this purpose. So to which extent your proposal, the internal consistency test, will increase this trend to use state aid rules for tackling tax avoidance, which is not the original intent of state aid rules, or do you think that actually it will create the opposite effect?
Okay. Ruth, would you like to hear the other?
Should I take those two and then?
Sure. And then we can go on to the others. We've got.
Okay. So, I mean, everything Jerome said, check mark, yes. Yeah, I think it's pretty obvious that the Commission is using the state aid rules to try and curb tax competition. There was also, I think, a little jockeying between the Commission and the OECD, right? So sort of like, hey, BEPS, I can BEPS too, I want part of this action. But, and this goes in part also to Leo's question about, well, are we just giving up the game then on tax competition and using state aid to police tax competition at all? And I think the answer to that is no. I think you can have a principled discipline approach to state aid using the internal consistency test that still has bite for tax competition. So one way is the way that I was just talking about with Celia, which is, if you're going to have a 10% rate, you've got to have it, for foreigners, then you've got to have it for domestic people too. So you've got to internalize the cost of the favorable policy into your own domestic situation. So it's costly. So that's one way. Another way is, it is not clear that the Irish branch allocation rule as described by Ireland is internally consistent, okay? You cannot pair under the internal consistency test a one-sided transfer pricing method for branch allocation with exemption. That's not internally consistent because you would never pick up the residual, right? On the branch allocation side, you just tax the Irish activities, and on the the imagined other side of the transaction, right? Let's say that the head office, instead of being nowhere, is in France. If France has an exemption system, the residual disappears into thin air. Okay, that's a problem. That's not internally consistent, right? What Ireland does in a purely domestic situation is tax all the income. So as judged by Irish domestic law alone, right? I mean, I don't actually know what the Irish outbound rules are, right? But if Ireland has exemption outbound, that's a problem. So, the Commission could start pursuing internally inconsistent allocation rules. That would be an appropriate thing for the Commission to do. It could do so in a bounded, predictable fashion. Countries would know in advance. They could know by applying the internal consistency test whether they have allocation rules that are internally inconsistent, right? Other people could just look at the statutes and say, hey, this is internally inconsistent. Instead of just waiting, gee, what will the Commission tell us the state aid rules require? It's a sui generis standard. We can't, we're not allowed to know what it is, okay? There's this story about the Commission giving a slide presentation about what it thought the arm's length standard was, and then being unwilling to share the slide deck with people outside the Commission. That's a problem when your standard is a literal secret from everyone outside the organization, right? And you're, public officials. Okay, so I think that the state aid, the internal consistency standard does have bite in the tax competition sense. It is secondary to the main goal, which is to promote level competition, okay, between enterprises of different states. Let's see. So yes, Jeroen's point about qualified majority voting. Yeah, I think that there is some element here to legislating by the back door, right? So the commission is frustrated with the voting standards, unanimity. That's a very stringent voting requirement, and so to some extent, it may be trying to implement its policies anyway through affirmative exercise of the powers that it actually has. Obviously that's really problematic, right? The reason why there's unanimity in the treaty is that that's how the states want it, right? So it's problematic to go from a situation in which every state has a veto to a situation in which essentially no state has a say, right? The commission knows what the arm's length standard is. Only the commission knows what the arm's length standard is, and that's it. And we've already, the general court has already said that that's going too far. But we'll see what the Court of Justice says. Rulings are a genuine problem. They're a real problem. The idea that the state would give a special deal in a ruling, it's secret, it's obscure from the public. No one is going to be asking what these rulings say. So I do think that there's a reason for the commission to be looking at rulings, or for countries generally. Maybe rulings exchange is the answer to that. But I do think that rulings are a genuine problem. They can be a vector for states to preference particular taxpayers, and that is well within the sort of uncontroversial part of the enforcement powers of the commission. So I would say, yes, go after these secret rulings, but go after them with a standard that's clear in advance to everyone. This whole technique is really for cross-border. That's where it's most useful. That doesn't mean it's useless in the other situations, but I think, in the other situations where the problem isn't allocation rules that absolutely have to have a selection that is based on cross-border, right? The reason why the hard cases are the hard cases is because allocation rules have to be facially selective. And that derives from differences in, jurisdiction to tax. If you take, say, like the Italian textile case, the reason why that's not a hard case is because it's facially selective and it doesn't have to be, right? So the Italian textiles case says that textile workers get better treatment than workers in other sectors. It's not hard for us to figure that one out, right? We know that sectoral discrimination is illegal. It's clear there's a distinction made between sectors, and so when you have sectoral discrimination, it's going to be easier to say that there's not a good reason for that facial selectivity, and there's more likely to be facial selectivity there, right? Our trouble with tax is that we have to have facially selective rules for our allocation rules, but not all of them, even the ones that convey advantages or seem to convey advantages relative to domestic law, are the kind you would want state aid to eliminate, right? There are some that are there just because of differences in jurisdiction. You have to let them go, right? Ireland can't tax a branch the way it would tax a company. So, just going on with this Italian textile example. So, let's say you use the internal consistency test in the Italian textile case. All right, so every state privileges the textile industry. Okay, well, we see that that's problematic, but we could already see it was problematic. We don't need internal consistency to get at that. But internal consistency can still help, right? So let's say that instead of preferencing textile workers, Italy said, there's no social security tax in Italy. Okay, so now other states in the EU would say, well, that's not really fair. That should be regarded as a state aid, because that makes all the companies of Europe prefer to use Italian workers to other workers, right? So Italy is drawing in labor, right, offers to employ its workers by getting rid of the tax on the Social Security tax. Well, okay, that sounds right, but now let's apply the internal consistency test. All the countries require no Social Security contribution for workers. Well, now that distortion disappears under internal consistency. So what we're able to conclude under internal consistency is that that Italian rule, the distortion caused by the Italian rule, is attributable to a disparity, a difference in the Italian tax base from other tax bases. It is not an inherent discrimination that doesn't go away if every state has the rule. Rather, it's a difference, right? That goes away if every state has the same rule. So then we would say, I mean, on my view, we would say that, well, that's not a state aid, right? That's just a sovereign choice of Italy. We might say it's unwise and that Italy shouldn't do it, right? As a policy matter, but it's not illegal. It's not contrary to the TFEU. Impression of the Court of Justice is kind of taking a step back from some of the bolder opinions, and it seems like it's giving states more leeway now, especially in anti-abuse. So, like, you know, if you think about Cadbury as being something like a high watermark, you know, the recent decisions in the Hungarian cases, you know, are, I mean, let's put it this way: the court is not very demanding of the state when it comes to a justification, right? The court's kind of willing to accept, you know, okay, maybe there's a difference in treatment here, but the court seems to have a pretty good reason for that, and we are not going to look deeply into what that reason is. Okay, you say ability to pay, we believe you, right? No, you know, trust and don't verify. You know, is sort of the impression you get from these recent Hungarian cases. And if that represents like a genuinely really glad you asked these questions. These are great questions. So, you know, in part because this gives me an opportunity to plug an earlier paper of mine that I wrote in 2008, which is about internal consistency and the fundamental freedom. So you can find that on SSRN and download it for free and enjoy it. But, you know, just to answer your questions, okay, so, you know, so one of the questions was, what about a state's, under the fundamental freedoms, a state discrimination against its own nationals, right? Something sometimes called reverse discrimination. Okay. The internal consistency test does not care whether your discrimination is, you know, reverse or non-reverse. Okay, so under the internal consistency test in the United States, you can no more discriminate against your national's foreign income than against foreigners, you know, domestic in-state income. And there's a really good reason for that, right? So the prohibition, or the dormant commerce clause's prohibition on discrimination with respect to interstate commerce, it says that interstate commerce can't be treated worse than domestic commerce. It doesn't matter who's doing it. It could be your person doing it, or it could be the other state's person doing it. But the cross-border commerce can't be treated worse than domestic commerce. And, you know, so we look at that as just anti-protectionism, right? But anti-protectionism has a flip side, which can be described as anti-retentionism. In the same way that you can't keep the outsiders out, you can't keep the insiders in. Okay, and that is very clear under U.S. law. And in my view, should be so under EU law, which I think the fundamental freedoms are really the same idea as a non-discrimination principle under the Dormant Commerce Clause of the U.S. Constitution. Okay, so what about double tax? Yeah, so double tax is not impermissible under, per se, impermissible under EU law or U.S. law, right? Certain kinds of double tax are impermissible under US law for sure, and ought to be, in my view, impermissible under EU law. Which are those? Any internally inconsistent double taxation. Okay, So if you have a rule that says, and this is a real case from the United States called WYNNE, W-Y-N-N-E, okay? So there was a state, Maryland, and it had the following tax regime. On Marylanders' Maryland income, so fully domestic case, 5% tax. On non-Marylanders' Maryland income, 5% tax. On Marylanders' foreign income in other US states, 5% tax, okay? 5, 5, 5. Facially neutral, no credit. That is not internally consistent. If every state had that rule, then cross-border commerce always pays 10% and domestic commerce always pays 5%. That is, and this is what the Supreme Court found, that is internally consistent. That is unconstitutional double tax. It's internally inconsistent double tax. But the US Supreme Court specifically said, at the same time, Maryland could have a rule that said Maryland taxes 5% and tax on Marylanders' foreign income is 5% and no credit, okay? It just can't tax the inbound case. But another state could tax the inbound case, right? So Maryland could have a domestic tax and a residence tax, but no source tax. But a different state could choose to have a domestic tax and a source tax and no residence, no outbound tax. And both of these states could choose each of these options simultaneously, which would mean in the real world, there would be perfect double taxation on cross-border commerce between those two states. But because each state's regime viewed independently was internally consistent, they're each entitled to have it, okay? Now, there are good reasons why states wouldn't do that and why they credit each other, because they don't want to discourage, in the real world, they don't want to discourage cross-border commerce, but it's not illegal, right? Because it's not discriminatory as viewed from the single state's perspective. So in the US, whether you have violated the Dormant Commerce Clause does not depend on what other states are doing, right? That's a wrong, only you, the state, can commit, okay? So, if you're Gibraltar, it just doesn't matter what any other tax system is. Right? You look at this formulary system and you judge it by itself. And if it's different from all the other systems, well, so be it, provided it's internally consistent. And the reason why the court comes to that decision, the Supreme Court, is there's nothing in the Constitution that says what the allocation rule should be, that says what a state tax base should be. So the court says, I do not have the authority to tell you what your tax system should look like. I only have the authority to tell you when you have discriminated, you have to stop. Now, if you want everyone to have the same rules, well, go to Congress. Coordinate amongst yourselves.
Ruth, thank you. We've got time, I think, for one last question from Raymond Luger. Raymond, and then we'll bring it to close if that's okay, because I think we're
yes.
Not yet. Thank you. We've got time, I think, for one last question from Raymond Luger. Raymond, and then we'll bring it to close if that's okay, because I think we're
yes.
Not the half past one. So Raymond.
Thank you, Paul. First, allow me to say, Ruth, I think your paper again is well timed, because especially for internal consistency, as the European Commission is now thinking about creating a state aid regime that will apply with non-EU subsidies. And maybe if they start introducing this concept, they might find some common ground with the US there. So maybe it's helping us a bit in the near future. It also explains, it justifies my feeling that Gibraltar was indeed wrong, and you now provided for I think, a very sound reasoning for that. That said, there are two small things I want to add. First of all, you reflected a few times on the application in Ireland. I think there is one thing that we should all be aware of. The Commission was, of course, very much focused on its own interpretation of the at arm's length principle, and Ireland was trying to defend its legal system. But Ireland was rather selective, as were the other parties, in presenting what its own legal system is. It already was published, I think, by a number of Irish tax lawyers, that Ireland gave a very one-sided view on its own tax law, and maybe Irish tax law is not what it was presented in the Apple case to start with. So that gives another dimension already to that particular case. One other thing I would like to add is, and that is in response to the question that Stephanie asked to Ruth, if I may just say one point on that, on Richard Lyle's comment from last year. I had discussions with Richard on that before he published it. I think the main question about looking at state aid and anti-abuse measures is especially when member states fail to apply anti-abuse measures. So there's a lot of room there to discuss the question whether if you have anti-abuse measures in place and you fail to apply them consistently, that is of course an area where state aid can play a particular role, which is a bit, I think would say a bit on a distance on what Ruth was discussing today. So yeah. I'm afraid there's no real question buried in that. To be honest.
Well, so, you know, I mean, I think my one response would be, you know, what internal consistency requires is that every state's law has to be taken on its own terms. So whatever Irish law was, and, you know, so now we have to figure out what Irish law is, and hopefully Ireland would be forthcoming about that. But whatever Irish law it is, that's what would be tested, right? Likewise, whatever the anti-abuse rule is, you know, there's a separate question, and Steve Daly has written about this. You know, what about the tax administration? And you know, we should regard it as a violation of state aid if the tax administration violates its own standards, right, in administering the law, right? And there are as many ways to deliver tax subsidies, you know, as there are hours in the day. I mean, more, right? There are lots of ways. Many are non-transparent, right? So when the tax administration does it, that was the real problem with the rulings. That's why they were so troublesome. Is who's ever going to find out about this, right? And you know, then when the states had to turn over their rulings, we saw what they were really doing, right? And we saw what happened with LuxLeaks. So you know, the state's rule. The separation or the allocation of power between the states and the commission requires that the states retain a certain amount of authority over their own tax systems, and as such, right, they're in the driver's seat. They get to decide the rate, they get to decide the base, they get, you know, within certain limits, but you have to take their law as it comes, not use some external standard.
Raymond, Ruth, thank you both very much indeed. I think that's bringing us to the end of this session. Just to say a huge thank you to Ruth and to all those who've contributed to today's rich and broad-ranging discussion. Thank you. And I'm sure we'll show our applause in a second, an appreciation of Ruth. So thank you, Ruth, not only for presenting your paper, but standing up to scrutiny and challenge for the past 40 minutes. That's really, really helpful. Thank you. The next session of the Tax Law and Policy Group is going to be notified shortly. It will be a research student presentation and discussion, which will be taking place in the later part of this term. Details to follow. And clearly, we are just one of a number of fora in the tax community. We've got cities, International Tax Justice Group, Centre of Business Taxation, and of course the Virginia-Oxford Dialogue. So many opportunities for some further engaging discussion. But I think if it's okay with everyone, we would like to conclude now. And speaking personally and on behalf of everyone, Ruth, thank you very, very much indeed for your.
Thank you so much. Terrific questions. This was really fun for me. Thanks a lot.
And we really look forward to seeing you and all colleagues on the call today at the next session. So thank you very, very much indeed. And have a good day, everybody. Cheers. Bye.